Investors, it's about time that we actually let our economic reality hit us. The warning signs out of the Federal Reserve, the very same warning signs I've been sharing here on the channel. Now, chances are, if you've clicked on this video, you're here for 7 dividend stocks worth loading up on right now amidst all the market uncertainty, because let's face it, these volatile times present opportunity. And it's in these periods of volatility where I actually invested in the perfect dividend stocks to ultimately drive me to over $100,000 in my portfolio. But before we get to these dividend stocks today, if you're new here, I'm Ari, your dividend investor here on YouTube, looking to keep you updated with the need-to-know economics and shed light onto the discounted dividend stock ideas on a weekly basis. With that, let's dive right in. So let us get started here with a quick account update on my portfolio, whereas I'm currently sitting on $118,718.77 within my brokerage account. Now that's down considerably from about a week ago when I was up by over $126,000. It's about a 6+% loss. However, if you've been watching my videos, I've been talking about what I call emotional investing, which is a phenomenon seen during earnings season, whereas we always, without fail, see run-ups and bubble pops because investors are investing with delusional hope, a false sense of optimism, and ultimately just their emotions. So towards the end of earnings season, we typically get a nice decline. But more recently, we've seen some rather alarming news to be aware of, especially as these news bites have really spooked investors and helped spur even more of a sell-off. Now, in a nutshell, labor market strength, bank credit ratings, and the Federal Reserve. But not to worry, I'm here to break down the need-to-knows because it's all going to be important for you. So the big three. Well, first and foremost, how about we just talk about the labor market? You need to know that despite all odds, especially elevated interest rates, the labor market remains incredibly robust. Heck, employment report after employment report, we only see strength and more jobs being added to the economy. But shelf that momentarily until we talk about the Federal Reserve. But before we do, another piece of noteworthy news is the fact that credit agencies just keep downgrading our banks. Now, first the regionals, and now according to Fitch, we see the big dogs like JP Morgan, Bank of America, and Wells all under fire with downgrade ratings coming soon. And now we're going to input the Federal Reserve. Whereas Fed officials have only remained hawkish on raising interest rates because according to the latest FOMC meeting minutes, they foresee further upticks in inflation and a necessity to raise rates again, especially as they feel that the labor market can handle those hikes. Which is not new news if you've been subscribed to the channel and hear me talking about this every single week, but this all creates a very panicked environment, and for good reason. You see, we could all be in a downturn, perhaps a 5 to 15% downturn come the year's end. The Federal Reserve will keep hiking these rates, or even if they don't, we're still going to be experiencing a very pressuresome environment. But here's the real key, especially as stocks are falling. Be there to buy the discounted dividend stocks. You see, the real magic of dividend investing and how I built my portfolio to over $100,000 so quickly was because I never failed to seize the opportunity on quality dividend stocks at discounted prices. So how about we get to these 7 that I have for you today? And investors, let me tell you something. You're going to want to add them all to your watch list. Yeah, they're that good. With that, up first, a dividend stock that I only ever regret not buying more of back when, Lockheed Martin, ticker symbol LNT, which is the world's largest and most dominant arms defense, aerospace, and info security technology contractor in the world, delivering customized solutions to meet the needs of their diverse clientele. Now, you gotta know that their largest client is the US government. With their limitless budget, Lockheed was able to secure a $489 million modification deal with the Navy, another $556 million mod deal with the Army, and as of a couple days ago, another joint venture deal totaling $116 million. Now that's just about all you need to know in terms of Lockheed's book of business. But here we are with the share price that's down by almost 6%, trading for $445 right now, coming in at a P/E ratio at 16.5. Likely for multiple reasons, but one of which is just the fact that we're not really in focus on a Lockheed play right now in this environment. However, just wait, because when all is said and done, Lockheed will be soaring again, especially when militarily upgrades will need to be made across the board, which is likely why Lockheed insiders have begun to buy shares, and even more likely why smart money has been doing the exact same. Both cases I'd imagine for the longer term. As for analyst forecasts, they are shedding light into 11% worth of upside to a share price of $494.62. And until then, we have a dividend yield that's doubling the sector average here at 2.6%. Now, investors, before I actually cover the next 6 dividend stocks for you, you have to know that the more that thumbs up button is tapped on by all of you, the more YouTube actually puts this video in front of more dividend investors, which allows me to help more investors out. So this is a direct call to action because I need your help in tapping on that thumbs up button to literally be a part of something bigger than yourself. And while you're at it, be sure you actually subscribe to never miss a single dividend stock that's discounted. Now with that, let's get back to it with Discover Financial Services, ticker symbol DFS. It's a direct banking and payment services provider, predominantly in the lending business, whether it's with credit cards or home, student, auto, or personal loans. Now, Discover has been tumbling over the last couple of weeks naturally, as it's a financial sector play, but moreover with the news like their CEO resigning. But this one is in fact on sale, and I think all the bad news is priced in. So get your hands on this industry leader. I mean, 10% compounded annual growth and evidence to prove it's over the last decade, historically, very high customer service satisfaction. We are here with an opportunity as it's trading for just $90 per share after falling from $121. That's with a PE ratio at 7.1, and while we're at it here, it's not going to be the overnight $1 million flip, but with plenty of analysts seeing a soaring share price, coming up to a share price of $116 per share, and until then, a solid 4.41% dividend yield to enjoy. Moving on to our third dividend stock that you may not expect me to mention, but one that I've really enjoyed being invested into for reliable dividends is Darden Restaurants, ticker symbol DRI, which is a restaurant operator with some of America's most reputable brand names under its belt, from the Olive Garden and Longhorn Steakhouse to the fancier Capitol Grill and Eddie V's. Now, why the restaurant business and why now? Well, I don't really foresee Darden's brands getting hit too hard amidst economic volatility, and we only ever see a proven spend record, especially when times are tougher. Everyone still likes to wine and dine their troubles away. However, it is likely to be a little bit more of a pullback here, so we can see right now it's trading for $160 per share. It's down from $172 in July, with a PE ratio coming in at 20. And my take here is that you should put it on your watch list, and should it slide a bit more, well, I'll leave the decision in your hands. But we do have the green light from analysts with upside of over 9.74% projected, coming up to a share price of $175.94. And until then, how about this strong dividend yield coming in at 3.05%? Now, before I mention this next one, I want to preface by mentioning some of their clients like McDonald's, Johnson & Johnson, ExxonMobil, Pepsi, Visa, Apple. I mean, this list goes on when it comes to Omnicom, ticker symbol OMC, which is a massive advertising, marketing, and communications umbrella organization that overall operates out of 100 countries with 5,000 plus clients. So in terms of reliability, it's all there. But when uncertainty and fear build up in the market and businesses are forced to cut back on spending, Omnicom always takes a hit, to which it's now trading for just $79 per share after nearly hitting $100 per share back in July, with a PE ratio coming in at 11.8. And of course, this sell-off comes after weaker earnings, but are we really taken back after the environment that we've been living in? At least I'm not, and actually optimistic that when all is said and done, everyone's going to need some more marketing and advertising work once again, which is likely why analysts remain bullish, with 25% worth of upside predicted, coming up to a share price of $100 per share. And as for shareholders, well, we're all going to be collecting on the 3.5% dividend yield. Next up, I want to circle back to Stanley Black & Decker, ticker symbol SWK, especially after the news of Warren Buffett's $814 million investment across home builders, which should tell us that even the master of the market himself is betting big on the future boom in the industry. But as we mentioned now, Stanley Black, we have to note that they are the largest tool manufacturer in the world, manufacturing all the very tools and supply that Home Depot, Lowe's, and moreover, those home builders that Warren Buffett's betting on. Now, I already bought when Stanley Black was trading for around the $80 per share mark, but it's now trading for $91 per share, and I think that's still plenty of opportunity for us as investors to take advantage of it at a PE of 17.5, as well as the optimism from analysts with another 7+% worth of upside to $98.36. I think that's a near-term outlook, but either way, shareholders, we're going to enjoy a 3.44% dividend yield. Moving on to dividend stock number 6, we're going to jump into the healthcare sector to play it safe, but keep it profitable with Bristol Myers Squibb, ticker symbol BMY. Now, did I just mention this one recently? Yes. Which means take it seriously, as Bristol Myers is a global pharmaceutical company and continues to lead the industry in providing some of the most advanced therapeutics out there. Yet this gem is down 13% year to date, trading for only $60 per share with a P/E ratio coming in at 16.2, all because of recent acquisitions in a rather high interest rate environment. But over time, I have a good feeling that this one's going to be a dividend investor's North Star at these prices, especially as analysts foresee upside over 16% worth of it coming up to a share price of $70.91 per share. And until then, how about the above sector average dividend yield at 3.64%? Now, last but not least here, we have one that I just can't get enough of as a dividend investor, Realty Income, ticker symbol O. That is, of course, everyone's favorite monthly paying real estate investment trust that delivers month over month thanks to its untouchable portfolio, having amassed over 13,000 properties in and outside of the United States, with even more expansion coming in the United Kingdom and Spain. Now, to fill those properties, over 1,300 clients, while always maintaining this above 98% occupancy rating. But now get this, Realty Income, as of this video, has been sliding, and right now it's already below $60 per share. It's a way down about 8.2% on the year. Now, hopefully it continues to slide in this environment that we're heading into, so I can load up on more shares, given the future of theirs remains pretty bright. And analysts foresee that share price rising back up to $69 per share. That's over 20% worth of upside, with a dividend yield coming in at a whopping 5.14%. Now, there you have it, the 7 dividend stocks worth loading up on right now. If you have better options than mine, be sure to let me and the others out there know by commenting below. And if you enjoyed today's video, you're also going to want to check this one out right here. But before you go, be sure to tap on that thumbs up button and subscribe to never miss a single video.